Good afternoon, and thank you for joining us for today's Market Update webinar. My name is Darcy O'Brien, and I'm the Chief Marketing Officer at Simon Quick, and I'm pleased to be moderating today's discussion. Thank you all for your patience. We know we're a couple of minutes late. We were dealing with a few Zoom issues, but we are ready and excited to get started. In recent weeks, investors have watched as we entered an extended streak of volatility in markets. This turbulence has been exacerbated by inflation in the US and concerns that the Federal Reserve will hamper growth in an effort to bring inflation under control. In light of this, our advisors have been engaging in conversations with their clients as well as our in-house investment research team. In hosting this webinar, we hope to share our investment insights with you, as well as provide an open forum for you to ask your questions. We're going to open with some prepared remarks and market commentary, and then open the floor to Q&A. Please use the Q&A function on Zoom to submit your questions. I will be monitoring the inbox, and questions will be answered in the order in which they were received. I'd also like to mention that this call is being recorded and will be posted to our website and circulated over email tomorrow. Now, before I introduce our panelists, I'm going to read a brief disclaimer. This presentation is for information and discussion purposes only. Please remember that past performance may not be indicative of future results, and there is no guarantee that the concepts and ideas discussed during the presentation will be profitable or prove successful. Now let's introduce our panelists. Today we have with us our Chief Investment Officer and Managing Partner, Chris Moore, and our Head of Investment Research, Wayne Yee.
Good afternoon.
Thank you, Darcy. Good afternoon, everyone.
To set the stage on what we're seeing in markets, I'll pass it over to Chris to make some opening remarks, and then Wayne will provide some marketing commentary.
Great, thank you. We felt it was kind of timely to host this webinar to address all of your questions. Certainly, it's an extraordinary start to the year, with equity markets down 16, 17%, depending on which market you're looking at, and bonds down nearly 10%, as Darcy mentioned, on the back of what we expect to be a higher rate environment, certainly, and with the war in the Ukraine creating additional volatility. This has been a challenging market, without a doubt. There's really been nowhere to hide. It has been a difficult period of continued volatility, and we wanted to kind of get out in front of it with all of you and give you some data around what we're seeing in markets today, and certainly where we think we're heading. But also, how are we positioning your portfolios with that in mind? So as we kind of kick off the session, please don't hesitate to fire off some questions at us. We want this to be an open dialogue as opposed to us presenting at you. I will now turn it over to Wayne as he will walk through a couple slides on markets today.
Yeah, thank you, Chris. I'm just going to set the backdrop for what we're experiencing in markets right now and kind of provide some initial impressions and thoughts, and then we'll take it from there in terms of the Q&A. So on this first page, what you're seeing is a quick snapshot on where broad indices are over the past couple of years and where we were year to date. That number is as of April. Obviously, the market's moved a little bit more in the month of May. But what's kind of notable here is on the top, we have S&P kind of markets outside the US, the ACWI ex-US, as well as NASDAQ, Dow, what have you. They're all down about anywhere between 11-12%, the NASDAQ notably down 21%. This is off a pretty exceptional years, looking at 21 and 20 to the right, where they have shown kind of really exemplary performance. And if we pull this even kind of multiple years kind of thereafter or earlier, you'd see strong performance as well. So this is a different market. It is not a new market, but there are kind of rotations that are going on in the marketplace that are driving some of this. Something that is notable is that Barclays Agg, so the second from the bottom in that top part, that's the fixed income index, which is predominantly driven by US Treasuries, which are highly protective, kind of principal protected assets. That index in itself is down almost 10%, which is a huge number. A lot of that is because of interest rate sensitivity, and we'll touch on some of the divergences that we're seeing in equities and fixed income. And just really quickly on the final bottom half of this page, Things are down a lot: technology, consumer discretionary, internet-based stuff, which is all kind of as expected. The bottom three: utilities, staples, and energy. Notably, energy is up 40%. This is off a very strong performance in 21, but the notable lag in 2000 on the back of COVID. So that's the one sector which is relatively small. It's at 4% of the overall S&P index right now. That's up though from a low of about 3%. So with energy rallying and the rest of the market selling off, energy has become a relatively bigger component of the S&P. This chart, we're not going to go through every single detail on the chart, but what this shows you is that earnings year over year have continued to grow in the index. The green line is market consensus expectations on forward earnings. The blue line is last 12-month earnings on the S&P. And what you can see is after the 2020 recession and this big sell-off, you've seen this steady climb higher of earnings kind of results, actual results, which is the blue, as well as expectations, which is the green. So fundamentals, the purpose of this slide is just to show that fundamentals have been positive over all this time. Fundamentals alone, though, aren't the driver of the markets. It's expectations for where those earnings go. And everyone should be kind of relatively familiar that there's been a lot of inflation in the world. And on the back of that, the Fed, particularly in the US, has been looking to stave off that inflation by essentially raising rates, which we would kind of see most evidently, as well as shrinking the government balance sheet. So those two effects are meant to slow down the demand, both from a consumer and from a corporate perspective, financial perspective, and to kind of slow down inflation, which is detrimental to risk assets and investors broadly. So it's really this inflationary pressure and transition that we're in that has been driving markets down, because as I mentioned earlier, fundamentals thus far have been strong. On this page, I picked bad colors because they're so similar, but what you can see in this green line, this is the PE, or the price to earnings multiple. And you can see that, like, yes, S&P had really kind of run higher into that mid-20s level. And we've collapsed down to this 17 kind of forward PE basis. And you can see that this tealish color, the S&P also falling in line with that, because fundamentals are improving, but valuations are compressing. And that is resulting in this JP Morgan chart where you can just kind of see we're right around average, kind of 25-year average PE. So very fair value. Now, there's a lot of other noise around this, but we could say that the market, based on historical valuations, is fair today. But rising rates, that's what's really pressuring the ability for markets to continue to move higher with earnings. And we can see on this chart, in other periods, that 16, 17 PE, even in rising rates, has been able to stick around, meaning that in a rising rate environment, you don't necessarily need to see a 13, 14 type PE. You could have rising rates to a healthy amount as well and still run at a 16 PE. And then that means that earnings should be the big driver of kind of S&P returns. Quickly on this chart, over the past 6 rate hiking cycles, the S&P on average has been positive. Now, there are periods of negative returns on the S&P, but on average, we have seen positive returns on the S&P in rising rate environments. It is the current pacing at which how high inflation is right now, and the pace at which the Fed is trying to raise rates, and some of the uncertainty around the conviction of the Fed raising rates that has created a lot of uncertainty and market pressure. One quick slide on fixed income. Fixed income, as and using the Barclays Agg as the benchmark, is highly protected from a principal perspective, in the sense that investors right now should not expect to see any significance defaults in the fixed income universe. This is predominantly investment grade. It is all investment grade and heavily U.S. Treasury oriented, but default risk or losing money is not the concern. It is the lack of value, of relative value of what you're getting from owning the Agg, which historically was yielding 1.75, which is now yielding 3.43. And when yields move up, that means prices move down. Mark to market, kind of unrealized valuation prices are moving down, and that's the pressure you're seeing in fixed income. And the tough environment today is that typically equities and fixed income move in opposite directions. But in this environment, we're seeing fixed income widen or lose money, while equities are also losing value. So it makes it very difficult to hide anywhere. We saw this on the way up as well with the Fed tightening and made fixed income really perform really well, while equity still rallied in the midst of that. But we're seeing that pullback for both asset classes. We don't think this is a new forever. We do think this is a temporary effect. But in this current rotation, you are seeing both asset classes sell off. So what we really want to talk about here is just like, where do we go from here? And we'll spend a lot of time on this element, and I'm going to try to rush through the next few slides. But this is not new. We've seen market corrections. We've seen bear markets in the past, most notably during COVID. But you will see 10, 15, 20% type market corrections over a span of a 5 to 10 year period. And they're not, and they're relatively regular. And in every year, you'll also see these big kind of red numbers of kind of intra-year drawdowns, kind of how much can you potentially lose? How much were you down intra-year in the equity market? The gray lines show you where we are, where those calendar years ended in terms of overall performance. So you can see a lot more of the calendar years are positive, despite having a lot of negative return periods intra-year. But what's very important, and this is something that that drives our kind of comment on being consistent and persistently investing, is that if you pull out markets at the wrong times, and you never know when the wrong times are, but people tend to pull out markets when they're most fearful, you miss out on the days of recovery. And looking at this chart, this page right here, you miss the 10 best days of the stock market's performance, just the days, the individual days, and you're almost half the return of just being invested over the entire decade that this data was grabbed from. I would also comment, what's not on this graph, some of those best days follow the worst days. So when the S&P really sells off, you want to be investing in those markets because the ensuing day or two is when you may see some of those best performances. And that's what really drives to this kind of 37.90 number versus the 21. And over the long term, only focused in the 5-year, while in any single year, you have a lot of variability of performance or return on equities, as well as in fixed income. That's the green and the blue lines. Over a 5-year period. So if you're looking forward at any 5-year period, you're really cutting off the potential for losses down in that low single digits, while maximizing while catching a really healthy kind of upside opportunity. 5-year is a healthy area to look, but obviously if you look further out at 10 and 20 years, you can see that the bottom, the losses are curtailed pretty dramatically, and you can really build confidence around the upside levels of these returns. So in our market updates, we'll just provide our kind of asset allocation recommendations. We are pretty balanced across all asset classes currently. That's equities, fixed income, alternatives, liquid and private. But some of the nuances there, in this market sell-off, we are opportunistically buying equities, particularly for those that were target weighted, that are seeing their equity book sell off and falling into an underweight allocation. We do think this is a good time to be incrementally adding. We're not saying do it all in one fell swoop. We'll touch on that a little bit, but we do think you should be in a position of buying. We do have a balance between value and growth, but in that value bucket, it tends to be a little bit more defensive, not so much kind of energy cyclical. We like the US over non-US. We're not saying you should be aggressive in small caps, but we do notice that small caps are now trading below their historical valuation. So that's pretty interesting because mid and large caps are trading above, kind of in line or slightly above their historical valuation, but small caps have fallen off. So that's an interesting segment of the market to be kind of paying some attention to. Fixed income munis are really interesting given how much retail selling pressure has kind of impacted that segment of the market. And then finally, in alternatives, we've been spending a lot more time in real estate. Private equity, we think, is a long-term return driver and an outperformer for publics. However, in short-term periods, you will see fundamental pressure because it is all based on the U.S. economy. So we'll turn it back to the Q&A, but did want to just kind of lay out some of those initial comments.
Thank you, Wayne, for those prepared remarks. Chris, if there's anything you'd like to add, please go right ahead. Otherwise, I will start looking at the Q&A box.
Yeah, I would just a couple things I would add that I want to highlight in the charts that Wayne had up there. I think it's really important to reiterate his point around missing the up days, right? It is easy to want to sell out when markets are declining. That is human nature. Certainly with the negativity on CNBC and news media around what's happening in markets, it is natural to feel like we should be de-risking. However, with the comments that Wayne made, missing those up days significantly reduces your total return when you're invested in equity markets. And being able to predict the bottom, while we all want to try to do so, is incredibly challenging, and it could cost you quite a bit as the market recovers. The second thing I would highlight is in the chart that Wayne showed, the Fed funds rate relative to recessionary periods. It's historically, the Fed funds rate needs to kind of exceed 4% before we really start to see kind of that major contraction in the economy such that we enter into a recession. Certainly there's a ways to go between where we are now and where we're heading to, or I should say, and that 4% level. The third thing I would just highlight is the magnitude of the move in the bond market is extraordinary. The last time there was a decline of 10% or more in the Barclays Aggregate Bond Index, which is kind of a US benchmark for bond indices, was in 1980. So it has been an extraordinary move year to date. And what we think in many cases actually an overreaction to what is higher inflation today and where we think rates could potentially end up. So Darcy, kick us off with the first question.
All right, wonderful. The first one that's come in is from Brenda, and she asks, are we in capital preservation mode yet?
I can take that one. We are not in capital preservation mode. In fact, we're likely closer to getting more aggressive mode, quite frankly. As we've seen markets pull back on a year-to-date basis, and as we talked about previously in the slide that Wayne brought up, we do want to remain invested and capture the rally, especially for longer term capital, right? We have not monetized losses here. This is a fluctuation in value based on what's happening in the world and what's happening in markets. We want to remain invested because we appreciate that over time, equities have historically generated 9 or 10 or 11%, depending on the time period you're looking at. But we also appreciate that there is certainly inherent volatility associated with equity market exposure. We are in one of those periods of volatility today. As Wayne also discussed, there are a variety of fundamentals that we think remain intact that have us of the view that we should be maintaining our equity exposure here. This is not the time to be reducing risk.
Okay, a couple of questions have come in around inflation, so I'm going to paraphrase and address them together. How persistent do you think elevated inflation will be, and can the Fed contain it fast enough to ensure a soft landing?
I could take that one too. This is the million-dollar question. This is really what markets are trying to determine right now, and investors are trying to plan for. The question around how long will inflation remain elevated, and to what degree is it elevated relative to kind of a more normalized rate of inflation? The reason for that concern certainly is the Fed will have to respond to keep inflation at a controllable level. We're of the view that we will likely see an elevated period of inflation, certainly for the rest of this year, likely for the rest of next year. But our view is it's going to be a lot closer to kind of a 3% level than it is an 8% level where we are today. We are of the view that there are a variety of factors contributing to the spike in inflation, namely on the supply side, that we do think are likely to normalize. Whether that's this quarter or next quarter is kind of to be determined, but we do see some of these situations resolving over time, such that inflation will come down. One of which is seasonal. Another is certainly the war in Ukraine. There is, in our view, is more likely that the situation there gets better before it gets worse. Whether that's sanctions coming down with response to some agreement over time, or U.S. producers generating more supply in the oil market, such that we see oil prices moderate a little bit. And then lastly, I think the supply constraints related to lockdowns in China and the potential that those lockdowns ease, even if it's marginally, we do expect a lot of these factors to contribute to an inflation number that is coming lower between now and the end of the year. What does that mean for rates? We still think the Fed is going to be hawkish in their next meeting or two meetings, but we think it is more likely that we will kind of remain, let's call it somewhere between 2 3/4% and maybe 3.25% Fed funds rate between now and the end of next year, where the Fed is really making a decision that is going to be data dependent.
There's one additional question here on inflation that came in from Charlie, and he asks, what asset classes are more attractive in a period of elevated inflation?
Yeah, maybe I'll take that. There's a few ways to think about this, and also inflation. I'll think about it in the concept of the economy still kind of positive, still growing, maybe at a slower rate, but growing, but still having some level of inflation in the system at a kind of, let's call it, even in that mid to high single digits, which we don't expect it to be there, but kind of think about it from that perspective. But the natural response there is kind of anything that's a real asset, and that falls into agriculture, energy, land, real estate, like anything that holds a value without having to be produced, having to be manufactured. And I think from that perspective, that's why you're seeing a lot of money. That's why you're seeing energy kind of trade up as aggressively as it had, because there's been a lot of demand from the consumer side. There's been supply constraints, let's call it, because of geopolitical and kind of infrastructure investment. And those elements have caused energy to rally pretty aggressively. You've seen the same in ag and nat gas, what have you. So I would say commodities are probably the most aligned to take advantage or to benefit from inflationary effects. We would say that it is a very volatile grouping of assets in that bucket. So because of that, the short-term nature of it, because it's less fundamentally kind of analyzable, we tend to look towards managers that can have a diversified play in commodities and other assets. We do think that real estate, as a component of inflationary assets, real estate will benefit and does benefit. Now, the wrinkle there is that real estate has had a really strong run over the past few years, especially on the back of COVID. So you've seen a lot of kind of buy-in into real estate. So there will be cyclicality around real estate as well, generally. However, over the long term, it is an inflation-protected asset. It is very difficult to make more land, make more space. It's still important to invest fundamentally. So there's no really good passive way of buying real estate. We do still look towards active allocation. But we do think real estate is a good, fundamentally driven, long-term inflation mitigant that we like to align alongside equities and fixed income.
Thank you, Wayne. The next question comes in from Colleen. How should we be investing new money during a downturn like this? Is it best to invest it all now, stage it in, or wait for markets to go even lower?
I can take that one. This is a question we get frequently and have certainly addressed with clients individually in the past. And the short answer is it's an art, not a science. What I mean by that is there is ample data to support that putting the money to work and generally kind of letting it compound over time, putting it all at once and letting it compound over time, more often than not is the best solution versus trying to stage it in. That being said, there is kind of a cost to being able to sleep at night, to staging it in, certainly during periods of volatility and stress. It is hard for one to feel open and willing to take on risk in a volatile market, especially when the expectations are that rates are going to go up and inflation is going to go up, and everyone's talking about recession. Whether or not any of that is overpriced relative to what's happening in the market, the truth of the matter is we work with clients to come up with the best solution for each client on that front. I think if we were given discretion, our view is to put it all in, but we do want to come to a solution that works best for each client. And everyone has their own separate risk tolerance and certainly their own kind of willingness to withstand short-term volatility and everything that's happening in the world. So that's a decision that we'll collectively make on a client-by-client basis.
Our next question is from Eric. In anticipation of a proposed tax related to unrealized gains, how do Simon Quick analysts view offensive preparations today?
Darcy, would you reread the question?
Yes. So in anticipation of proposed tax changes related to unrealized gains, how do Simon Quick analysts view offensive preparations today?
I think the question is addressing some of the discussions around taxing kind of the high net worths that have significant, whether it's concentrated stock positions or real estate positions, even though they haven't sold those assets, the potential for taxing them before the gain is realized so that it's an unrealized gain, but yet a tax liability to the holder of that investment. Our view is that that proposal is very unlikely to go through. We don't see a significant risk that would actually happen for a couple reasons, but the biggest of which being in a scenario where someone owns Google stock and that goes from, let's say they have $1 million investment and then it goes to $2 million the next year, and then that individual holder has to pay a tax on the $1 million gain. If the following year, the $2 million position drops to $1.5 million, I don't envision a scenario where the government's paying them back. Additionally, the tracking of those investments and the ability to kind of collect on them, especially when they're illiquid in many cases, will be incredibly challenging, both for the government to track and for the holder of the assets to generate the liquidity to pay the tax. So our view is there is a very, very tiny chance of something like that even getting implemented. So we are not positioning portfolios in any way to account for it.
Our next question comes in from an anonymous participant. Have fundamental demographic drivers of markets changed in a fundamental way that makes your 1950s to 2021 data set insufficient for purposes of your forecasting? For instance, if you were to include 1929 through 1950 in your data set, does the rolling 5-year drawdown of 2 to 3% still hold true?
Yeah, maybe I'll touch on that. I appreciate the question, and it's kind of an interesting thing that we could go into greater depth offline. But for the purpose of this call, yeah, if we do pull back further numbers and we go further back into the Great Depression or what have you, those numbers do change. And I would say the JP Morgan chart, it goes back pretty far into the 1950s, but that still captures a 12% type kind of annualized return, with a lot of that coming in from more recent periods where, just even thinking about the past several years, just the past few years, we've been printing 20% plus type returns, or kind of 20-ish percent type returns. Last year in 2019, 18 was an off year, 17 was a strong year. So we've had some kind of dramatic strength in markets that have also pushed up that average. I do agree that if you kind of even pull that number even further back, that it would probably bring down kind of rolling returns more into that 7 or 8% in equities, which I still think is a reasonable number. But I would think in the midst of that as well, I would say monetary policy has changed, has been kind of, let's call it, refined and evolved from kind of from about a century ago, where in that sense, there's more of a focus on price stability and using the balance sheet and monetary policy tools to cut off some of the extremes. And I think in the vein of all that, it does create inflation, natural inflation. But I do think that the Fed wants to, over the long term, maintain some level of low inflation, whether it's 2% or 2% over a kind of long rolling period. They do want the markets to inflate at a slow and steady pace, and they will backstop it to allow for that and avoid some of the significant crashes that we've seen in the past. And kind of to that vein, like looking at even in 2020, and maybe the Fed, I would argue that the Fed did the right thing in March, April, in kind of the earlier stages of COVID. It's just they probably kept their foot on the gas pedal for a little bit too long. But in an action like that, I think that does mitigate some of the longer term drawdowns and kind of lag in performance in equity markets. So I think it's a fair question, but I don't think it really changes the thesis of equity still being a long-term kind of high single-digit returner with a 15% type volatility. I think that volatility component is still something that we need to think about. But we would say the overall math still holds true.
Our next participant wants to know, what are your views on floating rate loan funds?
Yeah, maybe because it's touching some of the major that we've onboarded on the platform recently. We have been buyers of floating rate credit assets for, I'd say, several years at this point. And that spans from kind of within the structured credit space as well as the direct lending. And even of late, we've added a couple majors to that space as well to take advantage of very low duration, economic resiliency, and earnings profitability at the underlying borrower level. Now, floating rate, meaning that as LIBOR or as interest rates move up, that the loans that that borrowers are paying interest on are also, the interest payments are also moving up. So that's a benefit to the investor, meaning that you're not subject to what's called duration risk or interest rate sensitivity to the same degree, really having very little interest rate sensitivity. So that's a positive. Now, if we were to hit a recessionary patch and companies start not being able to continue to pay on their loans, that's the potential risk. And that's something that we're thinking about. And that's where you want to make sure that the Fed is kind of slow and steady and not kind of forcing the country into a greater kind of economic kind of slowdown or negative GDP kind of environment. But in this current environment, we do like floating rate because it's duration neutral and because it or kind of zero duration, as well as picking up better credit spread and moves up with interest rates. So long-winded way of saying we like it. We're being careful not to overextend because there is credit risk, but right now we are positive on it.
Our next question is from Terry. You favor U.S. assets over non-U.S. Is this a valuation issue or a strong dollar play?
Maybe quick comments there. The U.S. dollar, we haven't touched on it really on the slides, but the U.S. dollar has really rallied tremendously over the past kind of half year. But our call on the U.S. overweight is not driven by the dollar. It is driven by the breadth and depth of our economy in the sense that resilient and wide and active participation in capital markets, lots of kind of self-sustaining resourcing, fluidity of that capital as well, and a Fed that overall is on the margin have been largely more dovish than hawkish. Now that's changing a bit, but still, I would say slower to adjust rather than being or reacting as opposed to trying to be too proactive and kind of forcing the economy into a recession. And I think those elements make for the US to be a little bit stronger and more diversified versus non-US markets, emerging markets, Europe being a little bit more cyclical. And cyclical, you could say in the very short term may be attractive because you benefit from some of these inflationary and kind of exporting effects. But over a longer period, that cyclicality cuts both ways. And if the US does slow down, we do think that the broader globe and non-US will also suffer. And we think the US is best positioned to be protective in those periods. We do recognize that the US market, looking at major indices, is a little bit more expensive, but we do think you are paying up a little bit for quality from that perspective.
Our next participant wants to know, with the Fed signaling more rate hikes, what bond fund duration do you recommend?
We are, I'm trying to look through, but my early comments on floating rate, we've tried to keep duration very short for a very long term. And this had been in the midst of the initial kind of tightening back even like in 17, or sorry, tightening of rates. So kind of the more dovish stance into 17. We maintained that through 18, and we've continued to maintain a low duration allocation exposure. And now where we are today, we're seeing the Fed and the markets expecting several rate hikes. And even in the near term, we've seen a 50 bip hike earlier this month. We will see 2 more likely coming in the next 2 months. So you are seeing the Fed become a lot more aggressive here. There can be more to go beyond what the market's expecting. But I would argue that we're probably closer to the right level, like approaching the path is closer to the right level than being wrong. And the markets, you can see that the markets have been moving in that sense. If you look at fixed income instruments, a lot across the curve, you've seen kind of yields move out to where the market's expecting rates to be. And from that perspective, we do think that there's probably we're close to being right, or where the curve should settle out in. So in that vein, we should not be afraid of duration. So all that was really decided. We should not be so afraid of duration looking forward. We should start looking forward and thinking about, well, are there opportunities to start extending duration? We're not saying do it all right now, but we do think as the Fed continues along this current path over the next couple of months, that as rates move out, we will likely want to start adding duration. Because when you add interest rates, that does become much more of a negatively correlated or a hedge to risk assets. And let's play this market out, and we did hit a recession, the Fed would likely pause, if not tighten, and kind of pull in rates. And in that vein, fixed income and things with interest rate sensitivity would actually work in your favor. So we want to be thinking about that potential and that diversification balance between fixed income and equities. So that's our forward thinking. But right now, I'd say we're probably across the board, across all assets, probably maybe in the two-year duration level versus an index that's at 6.5 or so. So we've tried to keep it very short.
Our next question is, are you concerned / how are you mitigating the problem of relying on fund managers who have no experience managing through an inflationary environment? Very few current fund managers have any experience whatsoever managing through a major increase in interest rates.
I can take that one, and I'm sure Wayne's got something to add. I think if the question is related to managers that were around certainly in the 70s and managing portfolios at that time when rates were moving up substantially, that's a fair statement that most of our managers were not around during that period of time. However, I would say the current managers we allocate today, many of them have managed through periods of time where the Fed was increasing rates, whether it was from 0 to 2% or 2 to 5%. So certainly periods where rates were moving substantially higher. I would say the bigger question is kind of how are we managing allocations to various asset classes if we think rates are moving up significantly. And we talked a little bit about that earlier. in, where we've certainly been adding exposure. I mean, late last year, we kind of reduced our equity exposure. Earlier this year, we shifted from growth to value within equities. We have had minimal kind of, or we've cut our interest rate exposure within fixed income. So we've made some decisions at the asset allocation level to help us manage through a higher rate environment. I think the fund managers that we're allocating to today, by and large, are experts within their universe, whether that's a growth equity fund or that's a leverage loan fund. They're experts within that universe, and it's kind of on us to decide how much capital should be allocated to those universes based on where we think rates and inflation will be. Wayne, anything to add?
Yeah, I think it's a fair question, and some of it's survivor bias, right? Survivorship bias, in the sense that back when rates were really kind of moving up higher, just being an outright value manager worked decently well. But then in a rate cutting and rate declining element, you've seen a lot of value funds, good value funds, kind of either close up or become family offices because of some of the kind of the big tidal wave of let's say broader kind of monetary policy changing like the investing dynamic. But so because of that, if we can't find the right manager, we will actively go into passive. In the allocation approach, there are kind of passive defensive as well as passive value ways of kind of balancing out exposure. But then outside of that, on the active manager front, we do want them to be fundamentally based in we want to understand how are they thinking about valuations, whether you view it from a comparison perspective, like a peer group comparison perspective, from a DCF perspective, and you could even say this from the real estate side too, like what kind of discount rates are you taking on your businesses, and kind of how much are you stress testing this to make sure that our managers are at least considering and thinking about changing kind of macro events as opposed to just the individual security selection. And on top of that, sticking to that core strategy. So what we don't want to see is a manager that says, that's a growth manager saying, you know what, growth isn't working, so we're not now going to become value. Like, that doesn't work for us. We want to make sure our growth managers are sticking to their core competency and allow for us to kind of decide and evaluate what's the right sizing for those managers. And then here at Simon Quick, our investment committee is tenured across business and economic cycles. And in those meetings, we're talking about not just what's going on right now, but what does this look like? What did this look like 3-4 decades ago? And how does that compare? And how should we be thinking about what's not being discussed now that was discussed back then? I think all that informs the asset allocation approach that we take in allocating to portfolios. But to the core of the comment, we want to make sure our managers are sticking to their core strategy and executing on it. We don't want them drifting because something's changing that they haven't been able to appreciate or understand in their investment tenure.
Our next question is from Jim. What are your impressions of the midterm elections on markets and inflation?
I could start. Honestly, I think at this point they're so far away that the market's not really thinking about them. I think that there's so much more to concern and entertain markets at the moment that not much has been priced in, really. I think as we get closer to the midterms and start to see maybe some of the early polling and predictions, we could start to see that factor in. But it'll definitely depend on the contribution of the midterms to market volatility will be dependent on what else is happening in the world, specifically the Russia-Ukraine crisis, and then what's happening on the inflation and interest rate front.
Yeah, and we just saw several seats confirmed at the Fed as well. So we know, at least from like a monetary policy perspective, you do have Powell, and I actually say it's a pretty mixed board in terms of kind of those that lean a little more hawkish versus dovish. That mix is always it's good because it kind of results in something that's a little bit more down the line. Same thing on the political front. We write about the elections. We've written about elections a couple of times in the past on kind of just while socially it may not be divided branches of the government make government less effective. However, in that not being effective does result in stability. And I think that's something that the markets always do appreciate versus uncertainty. The more, especially speaking specifically to the markets, the more transparent the more transparent and frequent that the Fed is kind of in front of markets and sticking to the core story, I think that's will ultimately build confidence that that the Fed is kind of now moving in the appropriate direction and kind of easing some of that uncertainty. Yes, inflation is high, rates will move up, but as long as the Fed can remain consistent in that path, that's where markets will feel a lot better.
Our next question is from Albert. Can you discuss your views on prospects for growth technology stocks and funds whose strategies overweight to this equity type, short, intermediate, and long term?
I'll start off and then Chris could correct me where I'm wrong. But we don't think any portfolio should just be growth or just be value. We do think there's value in balance across, but balance not being kind of one for one, but having a recipe that includes both. We do think whenever we look at growth companies, or maybe even stepping back, growth businesses over the long term is where we want to have exposure, because not just thinking about the next year or two, but thinking over the next 5-10 years, the companies that are innovating, winning market share, reinvesting in the business, those are the businesses that we want to be aligned with. Now, technology is enabling a lot of different facets of the economy as well as capital markets. So I take that technology comment more as kind of technology-enabled, internet-oriented. But those elements are fundamentally good things to own and things that will have natural moats around them to build scale and stickiness with consumers. In the short term, and also earnings have been good thus far. Earnings have been really strong through COVID, and that's why you saw tech-oriented and growth stocks do as well. There is a reversion to the mean in the sense that they pulled forward a lot of earnings, a lot of growth, and that's normalizing a little bit. It's still growing, just at a slower pace, and that's what the market's been focusing in on. And on top of that, rising rates causing valuations to compress has really punished growth stocks specifically. And we talk about how the NASDAQ is off about 25%, but when you look at the broad kind of spectrum of growth companies, they're in a true kind of bear market, kind of .com like correction where you're seeing 40, 50, 60, 90% type sell-offs in some of these businesses. So we do think that there is now some value that's come into growth. So that is the opportunity, but that's not the opportunity for today, tomorrow alone. We're not saying do like this is the time to do it. We do think that there is a disciplined, consistent allocation to growth because this, I think when we look back, we'll say this was a good opportunity to buy. It may take a year or 2 or 3 for that to fully express itself, but we do think that you're buying at reasonable valuations and growth companies, especially in the ones that our managers have been investing in, will steadily expand, get bigger, and be winners and reduce that valuation naturally just through earnings creation.
I would just add, a couple quick things there to Wayne's point. The first is over the last couple of years, especially post-COVID, anything growth related was a winner. You would just back up the truck and buy growth, kind of the higher growth, higher beta it was, the better. And during that environment, we certainly saw, the meme stocks and a lot of SPACs come out that really had many thinking, wow, this is just extraordinary. Are we kind of reaching a bubble type point here? What I'm saying is we were certainly overextended as it related to growth valuations. What's happened this year is a reaction to that and a response to that, where we think certainly rates are moving higher, inflation is real, and this is a massive rotation out of growth into value. But typically, that's worked in the past when there were expectations for much higher economic growth, right? Where the more cyclical names would benefit in an environment where value stocks and sectors typically perform better. We're not of the view that we expect kind of economic growth to be incredibly robust over the next couple of years. And because of that, we do think there is an opportunity here to buy a lot of the growth names that in many cases have been oversold. Does it mean they've hit bottom? No, they could certainly sell off more. But if you look out 3, 4, 5 years from now, we do think there are a lot of names today that have dropped 40, 50, 60% that you'd want to own and hold for an extended period of time. For example, one of our value managers, and we're not making a stock pick here at all, but one of our value managers yesterday was buying Netflix. So, I think there are certainly companies that are attractive today relative to the growth expectations on a going forward basis, where PEs have compressed substantially and likely to the point where they're discounting the potential revenue and earnings growth for some of these technology companies.
So we are coming up on an hour, but I will just ask the last 2 questions that have come in. Maybe we can quickly address those. These are both from Brenda. Are you seeing fund managers sell their portfolio losers now in this market to preserve capital? And what is your outlook for energy stocks and fossil fuel?
I think, and this is this is not just me guessing, it's kind of reading into investment portfolios as well, but it's a little too late to be selling the losers now because those have been sold off the most. But what we are seeing is that if they're selling to buy something else that may have either sold off more or sold off to a relative degree that was unwarranted. Meaning maybe you're selling that small cap stock to buy a larger cap stock that had one poor quarter but has plenty of cash to backstop it more than whatever the price action may have been. So there is an upgrading opportunistically, but I would view that more as an upgrade because of kind of baby with the bathwater situations on kind of high quality businesses, rather than selling to window dress and build up cash. Now, I would also say, while this past kind of 4.5 months have not felt great in public markets, this volatility, we do expect there to be an elevated level of volatility than what we experienced in the past, partly because of what monetary policy is doing, in the sense that the Fed backing out does create just naturally more volatility in the world. And I think there has been a steady move to upgrade portfolios in the midst of that across growth managers, value selling the winners and buying more defensive, kind of rotating away from some of the heavily cyclical stuff. Even in fixed income, we're seeing, which has fixed income kind of liquid, low duration. You are seeing some adjustments there of just kind of buying that next business with a little bit more cash flow or a little bit more interest coverage, or being able to put in a little bit more covenants. So this environment is creating the ability to upgrade portfolios across the board. We haven't seen a get out, get defensive kind of mindset. Some of our managers have been kind of actively out there in market saying we're buying. We're not buying everything, but we are actively investing capital into this sell-off because it feels overdone. And then in energy, and energy's had a tremendous run over the past, definitely last year and continuing on into this year. We do not view ourselves as kind of energy specialists. We do recognize what's going on in the energy and broad commodity market. But because of the volatility and some of the way it trades, we defer a little bit more to some of our macro exposures to take advantage of that. And they've been beneficiaries of that, as well as playing some of the FX and rates elements as well. So, energy continues to be, does it stay at peaks? Probably not, but it does stay elevated for some time. But we rely on our more macro diversified managers to take advantage and adjust around that, because they'll also do it through the commodity than the stock in itself. The stock and the commodity should trade similarly, but the commodity is what's really driving the appreciation there.
Well, thank you both. At this time, there are no remaining questions in the queue, and I'd like to thank everyone for taking some time out of your day to join us on today's webinar. And a special thanks to Chris and Wayne for your commentary today.
Thanks, Darcy.
Thank you. And as a reminder, we will be circulating the webinar recording over email tomorrow, and it will also be posted to our blog. If you have any additional questions, feel free to reach out to your client advisor or submit them to events@simonquickadvisors.com, and we would be happy to address them offline. Thanks again for joining us, and have a great evening.